For the first time in 40 years, inflation has become a problem in the developed world. Thankfully, central banks have been up to the challenge, and they're willing to stamp out this inflation by taking liquidity out of the system and hiking rates. This has been led by the Fed, who's already hiked rates over 300 basis points. We believe there's more to go into 2023. And then the Fed is likely to keep rates at those elevated levels through all of 2023, only starting to cut rates in 2024. That's because they are really motivated to stamp out inflation. They don't want to make the mistake the Fed made in the 1970s of cutting rates too early. What's the risk of that? Of course, slower growth. Our base case is for a slight recession in the United States. More likely a little deeper recession in Europe, given that inflation is a bigger problem there, and the ECB is going to have to take greater action to bring inflation under control. Despite our base case being a mild recession in the United States, we still see ample opportunity in the fixed income markets, particularly in the corporate space. You see, this will be the first time on record that entering a recession, companies didn't spend the previous year or two leveraging up their balance sheets. Instead, what companies did in a period of very low rates was pay down debt and term out debt. If you look at the high yield market, for example, only 20% of the market has maturities over the next 3 years. Ultimately, what leads to a default is not just a weakening of a business or an industry, but that coming at the same time as a liquidity event. So we actually believe that defaults and loss rates are going to be quite low in the credit markets, and think that yields that are quite a bit higher than they've been in a long time are going to lead to very strong returns for investors that stick the course. We also see opportunities in emerging market debt bonds. We focus more on the structural parts of the market, the hard currency, sovereign, and corporate issuers, and much less so, if at all, on what we call the more cyclical parts, the local yield curves and foreign exchange. We're seeing opportunities particularly on the corporate side today. For example, Macau gaming, with China about to reopen, we think is a solid place to invest. Indian renewables, with the focus worldwide on responsible investing and ESG, is another good opportunity. As always, very important to stay diversified in emerging market bonds because they can be so volatile. Times are uncertain. Markets are very volatile, but investors need income. So what are they supposed to do? How do they navigate these very perplexing markets? In our view, the most important thing is to stay the course. Let the power of time work for you. Yes, in the short run, prices can go up and down. You can have volatility. But in the long run, time is your friend in fixed income. Every day that goes by, you earn that coupon. And as long as the issuer, be it a company or some other entity, makes good on their obligations, you're going to get back your money at the end of the day. Being on the sidelines, even for a short period of time, can be very harmful to investors. We actually looked at the past 30 years of returns in the global high yield markets. You've gotten about 8% annualized. If you miss the best month of every year, you lost over half of your return. You're down to 3.5%. And if you miss the 2 best months in every year, you essentially lost all of your return. Very hard to time the markets. Long-term investors get rewarded time and again, especially at these higher yield levels. No one can guarantee that you're going to have a positive return in the next 2 or 3 months. But it would be very surprising to us if over the next 2 or 3 years, investors didn't have a very positive experience from here investing in fixed income.
投资一定有风险，基金投资有赚有赔，申购前应详阅投资人须知或公开说明书。